You're staring at the gold ticker on your phone right now, and the numbers look like a glitch in the system. Gold has gone vertical, smashing records and making headlines that feel more like a financial thriller than a market report. But while the experts scramble to explain the latest spike, you're left with a sinking feeling. Is this just a lucky run? Or is the global ground shifting beneath our feet? My name is Tom, and we're about to analyze the cruel math of gold's journey over the last decade, from the $1,050 lows of 2016 to the record-shattering reality of 2026. We're going to see how the world's ultimate fire extinguisher finally caught fire. If you find this deep dive valuable, please consider supporting the channel by hitting that like button or subscribing. The year 2016 was the ultimate trial by fire for gold. It started in a quiet home office, staring at a price that felt like a stagnant pool, hovering around $1,050. Back then, every smart suit on Wall Street insisted gold was a dead relic. They claimed the economy was back on track and called you a fool for holding a bedrock. But as you looked at the mounting global debt, the math didn't add up. You were just waiting for the first crack in the porcelain. Then came June 23, Brexit. In a single night, the impossible happened. The British pound collapsed, global markets went into a tailspin, and gold did exactly what it was born to do. It acted as the financial fire extinguisher. Prices exploded, surging nearly $100 in hours and eventually peaking near $1,375. It wasn't just a rally, it was a middle finger to the establishment's narrative of stability. By the time the United States election rolled around in November, the script flipped again. The Trump trade sent the dollar into hyperdrive, dragging gold back down to $1,150 by December. Wall Street laughed again, calling the summer spike a fluke. But they missed the point. 2016 proved that gold isn't just a commodity, it's the only asset that thrives on pure, unadulterated uncertainty. It was the year we learned that when the adults in the room are wrong, gold is the only thing that stays right. You're looking at the financial headlines in early 2017, and once again, the math feels broken. After the adrenaline pumping, Brexit, and election shocks of 2016, the smart money is telling you that gold's run is over. The Federal Reserve is aggressively raising interest rates 3 times. To be exact, according to every textbook, that should be a death sentence for an asset that pays 0 interest. But you check the ticker at the end of the year, and gold is up 13%, sitting comfortably near $1,300. How? Because there's a massive gap between what the experts say and what the market actually does. While the Fed was busy talking about a strong economy, the United States dollar was quietly having its worst year in over a decade. But 2017 added a new layer of noise: Bitcoin. For the first time, the digital gold narrative began to compete for your attention. With crypto prices surging 1,900%, it felt like the political instability of 2016 was being replaced by a speculative mania. Yet, while the world was distracted by fire and fury, tweets regarding North Korea and the crypto moonshot, gold did something radical. It stayed steady. If 2016 was the year of the safe haven shock, 2017 was the year gold proved it could thrive even when the rules of finance said it shouldn't. It wasn't just a panic buy anymore, it was becoming a permanent insurance policy. You're looking at the charts in August 2018 and, honestly, it looks like a slow-motion disaster. After gold spent 2017 defying the odds, the Federal Reserve decided to turn the screws, raising interest rates 4 times in a single year. In the world of traditional finance, that is supposed to be game over for gold. By late summer, the price had bled out to a 2-year low of $1,160. And the smartest people in the room were telling you the United States economy was an unstoppable rocket ship. They wanted you to believe you were holding a heavy, useless anchor. But here's the part the banks didn't want you to see: the iceberg. While everyone was distracted by the booming 2017 stock market, the United States-China trade war was quietly beginning to choke global growth. Suddenly, the invincible stock market party turned into a brutal hangover. In December 2018, as the S&P 500 suffered its worst December since the Great Depression. Gold didn't just survive, it roared back to $1,280. If 2016 was about political shocks, and 2017 was about defying the odds, 2018 was a V-shaped reality check. It proved that gold is the ultimate counter-cyclical asset. When the music finally stops and everyone rushes for the exit, gold is the only door that stays open. You're looking at the charts in early 2019, and for the first time in half a decade, the ceiling is starting to crack. Remember 2018? The Fed was playing the tough guy, raising rates and telling you gold was a useless anchor. But by mid-2019, they completely flipped the script. They didn't just stop raising rates, they started cutting them. They realized the global economy was far more fragile than their glossy spreadsheets suggested. This created what I call a financial black hole. Roughly $17 trillion in global debt suddenly carried negative yields. If that sounds completely insane to you, congratulations, you're paying attention. Investors were literally paying governments for the privilege of losing money. In a world like that, gold's 0% interest rate isn't a penalty, it's a massive premium. Gold finally smashed through the $1,350 barrier that had been a cage since 2013, surging nearly 19% to finish the year above $1,500. While 2016 was a panic spike and 2018 was a test of resilience, 2019 was the year the macro stars finally aligned. Between the escalating United States-China trade war and a record-breaking gold rush from central banks, the message was clear. The old normal was dead. And gold was the only asset that knew what was coming next. You're sitting at home in March 2020, and the world feels like it's ending. You look at your gold chart, expecting a safety net, but instead, you see a crash. It feels like a betrayal. Remember 2016 or 2018? In those minor shocks, gold was your fire extinguisher. But in March 2020, the fire was so big that investors started selling their extinguishers just to pay their bills. It was a brutal liquidity crunch. Then, the adults in the room panicked. To stop a total collapse, the Federal Reserve launched infinite stimulus. If 2019 was about small rate cuts, 2020 was about flooding the entire global engine with trillions of freshly printed dollars. They told you it was necessary, but the math screamed something else. The physical scarcity of gold was about to collide with an ocean of paper money. By August, gold did what it had been threatening to do since the 2019 breakout. It smashed through its 2011 record to hit an all-time high of $2,067. In 2017, gold was a steady asset. In 2020, it became a survival asset. Physical supply chains broke down, and for the first time in decades, owning gold wasn't just a boring diversification strategy. It was the only way to opt out of a financial experiment that was spinning out of control. You're standing in line at the grocery store in 2021. And for the first time in decades, the numbers on the receipt are actually starting to hurt. Inflation is hitting a 40-year high, and every financial textbook tells you this is gold's golden moment. After the explosive, record-shattering run of 2020, you're expecting gold to moon. Instead, you look at the ticker, and the price is actually down nearly 4%, sitting around $1,800. Something doesn't add up, right? Here's the part where the experts start gaslighting you. The Federal Reserve is whispering in your ear that this inflation is transitory. They want you to believe the trillions they printed during the 2020 lockdowns aren't the problem. It's just a glitch in the supply chain. Meanwhile, a new rival is sucking all the oxygen out of the room: Bitcoin. In 2017, Bitcoin was a speculative distraction. By 2021, it was a predator, hitting $69,000 and stealing gold's spotlight as digital gold. Investors were so drunk on risk on gains from the stock market and crypto that they forgot why they bought gold in 2016 or 2018 in the first place. If 2020 was about survival, 2021 was a narrative battle. Gold didn't fail. It was just waiting for the world to realize that transitory was the biggest financial lie of the decade. You're watching the news in February 2022, and the transitory inflation lie of 2021 has officially gone up in flames. As Russia invades Ukraine, the global system catches fire. And you watch gold do exactly what it was engineered for. It acts as the ultimate financial fire extinguisher. Prices surge back to $2,050, nearly touching the record highs we saw during the 2020 pandemic panic. For a moment, it feels like 2016 all over again, where geopolitics is the only thing that matters. But then, the math turns cruel. To kill the inflation they helped create, the Federal Reserve pulls out a sledgehammer, the most aggressive interest rate hikes in 40 years. They pushed the United States dollar to a 20-year high, and suddenly, gold is in a brutal tug of war. By September, the price is bleeding out at $1,615. And the experts are back on TV telling you gold is a failed hedge. Here's what they weren't telling you, while you were distracted by the volatility. Central banks were quietly buying 1,136 tons of gold, the most since 1967. They weren't looking at the monthly price. They were looking at a world where the dollar was being weaponized. If 2021 was a narrative battle, 2022 was a structural shift. Gold ended the year flat. But while the S&P 500 crashed 20%, gold proved it was the only adult in a very childish room. You're looking at your phone in March 2023, and the headlines feel like a terrifying reboot of 2008. Silicon Valley Bank has vanished overnight, and suddenly, the safe money in your bank account doesn't feel so safe anymore. Remember 2018? Back then, just a few rate hikes were enough to drag gold down to $1,160. But in 2023, even with the Federal Reserve pushing interest rates to a 22-year high of 5.5%, something radical happened. Gold stopped caring about the old rules. While the adults in the room were busy explaining why gold should be falling because of high interest rates, the market was busy doing the impossible. Gold jumped from $1,810 to $2,000 in just 2 weeks. This wasn't just a panic buy, like the Brexit shock of 2016. It was a realization that gold is the only financial asset that isn't someone else's liability. By the time conflict erupted in the Middle East in October, the geopolitical risk premium we saw in 2022 returned with a vengeance. But the real, cruel math was driven by the central bank whale. Led by China, nations were dumping dollars for gold at a record-shattering pace, with global central banks buying over 1,000 tons for the second year in a row. If 2021 was a narrative battle, 2023 was a declaration of independence. Gold ended the year at a record yearly close above $2,060. Proving that when the banking system cracks, physical scarcity beats paper promises every single time. You're staring at the chart in early 2024, and the math finally starts to feel like a different language. For a decade, $2,000 was the ceiling. The invisible wall gold just couldn't break for long. But in 2024, that ceiling became the permanent floor. Remember 2018 or 2022? Back then, high interest rates were the kryptonite for gold. But in 2024, gold looked at high rates and laughed, surging from $2,060 to a staggering $2,700. What changed? The world stopped waiting for permission. While the Fed finally delivered a jumbo 0.50% rate cut in September, the real story was happening in the East. Central banks weren't just diversifying, like they did in 2022. They were on an insatiable buying spree to de-risk from the dollar. Combine that with a geopolitical red alert in the Middle East and the uncertainty of a United States election, and you get a perfect storm. In 2016, gold was a panic spike. In 2020, it was about survival. But in 2024, gold transitioned into pure momentum. It hit 40 separate all-time highs, proving that the global financial system isn't just tight, it's undergoing a fundamental realignment. You're no longer just watching a commodity. You're watching the world move into a gold rush 2.0, where the old rules of Wall Street no longer apply. You're staring at your phone in late 2025, and for the first time in this decade-long journey, the numbers look like a glitch in the simulation. Remember 2024? We thought $2,500 was the new frontier. But by October 2025, gold didn't just cross a line, it demolished the concept of expensive by smashing through $4,000 per ounce. If 2020 was a panic spike and 2024 was momentum, 2025 was a parabolic awakening. What happened? The double pivot. The Fed finally slashed rates. But unlike the recovery years of 2016 or 2017, inflation didn't go back into the bottle. It stayed sticky. You were living through the nightmare of negative real yields, where your bank account was a leaky bucket and gold was the only solid ground left. Central banks stopped just diversifying, they made gold their primary reserve, officially dethroning the dollar in their vaults. Throw in a global trade war and a frenzy of aggressive tariffs. And the message was undeniable. The system wasn't just tight anymore, it was fragmented. In 2025, gold stopped being a hedge and became the foundation. It's the ultimate trust-less asset in a world where trade has become a weapon and paper money has become a gamble. The math finally stopped being an opinion and became an inescapable reality. It's March 2026. And as you look at the gold ticker today, the atmosphere has fundamentally shifted. Remember 2016? Back then, the experts called gold a dead relic at $1,050. Remember 2024, when we celebrated breaking the $2,000 ceiling, like it was a once-in-a-lifetime event. Fast forward to today, and gold is oscillating between $4,100 and $4,600. The sticker shock is gone. The world has finally accepted a reality that seemed like a conspiracy theory just a few years ago. In 2026, we've moved past the safe haven panic of 2020 or the FOMO rush of 2025. Gold has achieved structural permanence. It's no longer a speculative trade, it's the bedrock of a new global financial architecture. While governments push programmable digital currencies, CBDCs, you're realizing that gold is the only off-grid asset that can't be tracked, frozen, or deleted with a keystroke. Here is the cruel math of 2026. Peak gold is no longer a debate, it's a headline. The easy gold is gone, and mining costs are skyrocketing. Supply simply cannot meet the insatiable hunger of central banks that have officially dethroned the dollar in their vaults. If this decade-long journey taught us anything, it's that in a system built on infinite debt, the only real freedom is holding the one thing they can't print. You're not just buying a metal, you're buying an exit strategy. The last decade proved that in a world of infinite debt, gold is the only reality check left. It's not just a metal, it's your exit strategy from a rigged game. If you're ready to stop following the noise and start following the math, hit that subscribe button. I'm Tom. And remember, real wealth is freedom, not a bank balance. Stay sharp, and I'll see you in the next one.